We invite you to preview the next acquisition by Darwin German Real Estate Investments. Introducing Silver Creek Apartments in Dallas, Texas. Silver Creek is a Class B apartment built in 1986 and consisting of 312 units. 30% of the property are 2-bedroom units and 70% of the property are 1-bedroom units. These are in great physical condition consisting of brick exteriors. The apartments are well maintained and located in a growing northern Dallas area, just blocks from the George Bush Turnpike major freeway. The property amenities include a completely remodeled clubhouse with a resident lounge and a full coffee bar. Outside, we have access gates, covered parking, and 3 resort-style swimming pools. This property has fantastic upside. Currently, there are 30 classic units, 184 full upgrade units, and 98 granite upgrade units. We know that this is a great investment because we will be assuming a 10-year note with 3 years interest-only financing at a 4.11% interest rate. Current T2 income is already higher than our first-year income projections. By taking the classic and full upgrade units to the granite level upgrade results in an additional annual rental income of $351,000. The additional income brings the overall property value to over $5 million. The demographic base is impressive with houses in a 3-mile radius averaging an annual income of over $100,000, providing room for rental growth. We are very excited to add this property to our ever-growing portfolio of investments. To find more information, please visit us at www.darwingerman.com.
There we go. So there's that. Okay, Silver Creek Apartments. Has anybody gotten the PPM already? Okay, a few of you. Good. It's 312 units, mostly 1-bedroom units. But in this particular area where George Bush is, it's also got the tollway just to the east. So straight on up, less than 5 miles away, is all of the new development there in Nebraska Furniture Mart area with all of the new businesses that have moved in. It's 1986 construction, B class, great condition. Now we're paying $33,650,000, which is $107,000 a door, okay, which might seem like a lot, but I've seen Class C properties selling in Plano for $120,000 and $130,000 a unit. So this is actually $107,000 is not a ridiculous price. Now we're projecting a 16.1% per year average return. Okay. The location, as you can see, this is a little bit weird. It's in the city of Dallas, Carrollton Schools, which is much better, and Denton County. As it said, the average income within 3 miles is $104,000, but also the average home price in that area within 3 miles is $245,000. Now the big thing about average income is you need to know what the average income is because you need to know what people can pay for apartments. Because rental criteria is you need to make 3 times the amount of rent. So if rent's $1,000, you need to make $3,000 a month, $36,000 a year. So we've got a lot of upside in potential rent there if it's $1,000 a month. It's beautiful. 3 resort-style pools, hot tub, dog park. It's on a creek. It's got great views of the creek in the back. It's got access gates, covered parking, which we can actually charge more for. Coffee bar, resident lounge, you saw all that. So it's a beautiful property. The interiors, this is the big thing. Classic units. That's a fancy word for old. Okay, so the classic units are just the old, what was there before. It's nothing fancy. Now they've upgraded a lot of those units. Now, upgrades on that might be black appliances, maybe Formica countertops, maybe painted the cabinets, did some of those things. But then they also went in and did granite upgrade units, which is just what it sounds. They put in granite countertops, sometimes new cabinets, new fixtures, new appliances, stainless steel appliances in a lot of those units. But those granite upgrade units then are even a much higher price. So our business plan on that is to go ahead and increase most of the units to the granite level upgrade. Now we need to keep some at the upgrade level. They call them silver, gold, and platinum or something like that. I forget what it is. But of those, we need to keep some in that mid-range price-wise. So we're planning on keeping some of those at the middle price, but trying to get most of them up to the granite level. Give you an idea. Okay, again, underwriting. I'm not going to go through the detailed spreadsheet of exactly how all the numbers communicate and everything like that. That's a much deeper dive. I wanted to get you guys the high-level information to know what's going on. Give you an idea. One bedroom, the effective rent. Anybody have any idea what effective rent is? Effective rent is what they're actually getting. So we actually look at the rent roll and say, okay, what are all the granite units and what is their effective rents? What are they actually getting? Now, those are rents that over the last 12 months for people that are in leases over 12 months. So we're in January. They could have signed a lease last January for the granite level. Well, rents might have been raised since then, or there might have been specials at some point in time. Whatever else, the effective rent is how much they're actually paying. Okay? Market is what they refer to as saying, hey, market rent is this is what we're asking right now. This is our rents right now today. Now, you can be real fancy and market rent could be $10,000 a unit. Doesn't matter because you got to look at effective, okay, and see what they're actually getting. Now, $928 is their ask, $847 is what they're getting. We budgeted on one bedrooms $945,000. That's a lot. I'm sorry, little faux pas. $945 per unit rent on those upgraded units, what we scheduled. Now, rents for that area per ALN, the average rent, this is an average rent for that area for a one-bedroom unit is $973. So we're performing using a performer rent that is much lower than what the average rent is for that particular market. Two bedrooms, same type of thing, almost $1,100 effective. Market $1,167. We're budgeting $1,206, so another $100 higher than what they're actually getting, again, over the last 12 months. But ALN, the average for that area is $1,287. So we want to be very conservative on what rents we can get. This is especially conservative. Our projected income, year one, is $296,000 per month. Okay? November, they collected $308. October, they collected $312. Okay. So we're budgeting our year one collections less than what they're collecting right now. Is that conservative enough? Everybody follow that? Repeat it one more time. Our budget for year one is $296,000 collections per month. They're already collecting $14,000 more than that per month right now. So we're actually projecting lower rents than they're currently getting. Okay? Now, our year two, okay, at the end of year two, so after our first 12 months and after our 24 months, we're looking back at that year two, we're budgeting for year two collections $328,000 per month. So that's only a 5% increase over what they're collecting right now, 2 years from now. Okay, is that conservative enough? Okay, I don't know anybody that would be that conservative. Okay, so we know we're going to hit our income numbers. That's going to be pretty simple. One of the things that I loved about this is it's a Freddie Mac assumption. What are interest rates right now on a loan of this size? What's that? About 5.25. It was about 5.25 about 30, 45 days ago. There's been better news from the Fed. The 10-year treasuries have come down a little bit. So it's about a 5% now, maybe a couple bips under 5%. But still, we're assuming a loan that's 4.12% interest. It's 4.1 something, so I just put a larger number at 4.12. It's a 10-year loan with 3 years of almost 3 years more of interest only. So it's a great loan. We're shorting the dollar, basically. And it's a 10-year loan, so we hold on to it that way. Great loan. Now, we have already got our KPs on there. And I'm a KP. Mike's a KP. And we've got 2 other KPs that are in there also. Also on that, each one of the KPs, should I say that part? Okay. Each one of the KPs is also investing $200,000. So myself and the other 3 or 4 KPs are all putting in $200,000 a piece of our own money. Our CapEx is $2,128,000. Now we used a different strategy on this. We're funding almost $1.5 million at closing for CapEx. Now, we are planning on having quite a bit of cash flow year one, but because we don't need it all day one, because we have to wait for leases to expire and turn those units as leases expire, we don't need all that money day one. So we're planning on using the cash flow to reinvest that cash flow into making the other units ready and improving those. So that's an extra $650,000 that we're going to use of cash flow to put into our CapEx. That does a couple things. That lowers our capital raise, so we don't have to raise as much capital. But the big benefit to you is that bumps the overall yield for you, because we have raised $650,000 less. Everybody who invests in that gets a little bit more ownership, which bumps their overall yield. So we give up about 4% yield of year one in exchange for a higher overall yield over 5 years. Follow that? Any questions on that part of it? Does it sound like a good strategy or a bad strategy? Okay, good. Okay, give you an idea. Our year one NOI, $1,950,000 is our projections based on income that's already higher currently than is our projection. Year 3 NOI, so skip a year, $2.4 million, 2.5 almost. And then year 5, almost $3 million in NOI. This is real important. I'm beating this into everybody's head every single meeting. Does anybody know what I'm going to say? Exit cap rates. I don't care whose deal you're looking at. I told you last time that I was looking at a deal. I don't even remember the property. They had their annual yield was between 1.5% and 2.5% per year over 10 years. That's the actual amount that you would get back, 1.5% to 2.5% per year. Their overall yield was like 18%. That was over 10 years. So they took, putting collections out over 10 years at, just say 4% over 10 years, and you know it's going to go up and down. Then they used a 5% cap rate in 10 years. That exit cap rate changes everything dramatically. And I put this on here so you can see. Take the NOI, $2,934,595. If we use a 5% cap rate, the value of that property is $58,691,000. 5.5 cap rate, 53 million. 6 cap rate, 48. 6.5 cap, 45. What do you think I used for my projection in 5 years? 6.5. Okay? Because I want to be conservative. We don't know where interest rates are going to be. We don't know what all those are going to be. Now, if I budgeted, if I did what they did 10 years out at a 5% cap rate, there'd be $13 more million to go to the bottom line. $13 million, that'd be 100% over 5 years, that'd be 20% more per year on average. It'd be great on paper. I mean, if I bump the return to be, hey, I'm going to give you 30% per year based on those assumptions, then it's unrealistic. So always, 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 always look at the exit cap rate on any projections you get from anybody, me included. Okay, so 6.5 cap, $45 million in value. If cap rates are staying low over those 5 years, then there's the possibility, if it's still a 5 cap, there's an extra $13 million that goes back to us. Okay? Any comments on that? Yes, sir.
No, one of the things about that I love about this property is that it sits on the corner of Midway and Roseby, and that's 8 lanes of heavy traffic. I mean, heavy traffic. So that's great for leasing.
Yeah, 33,000 cars a day right on the front of that, right by the front of the property. Any other comments on the cap rates? Anybody understand? Anybody want any more information on cap rates? How that's figured? Any other information? Yes, sir. Am I too conservative on rents? I might be. However, the market's still going great. Like we saw how it's going to. The outlook for DFW is still good. However, there's also some trepidation. The people that have 401ks or stocks that looked at their end of year statement and saw that, hey, 3 months ago I was 25% richer and now it's back flat. The stock market goes up and down. Real estate is going to go up and down, but a lot less dramatic. But there still might be, people might be afraid of a dip, okay? Because there's a possibility in 2020, 2021, somewhere in there, that there is a little bit of correction. I want to make sure that we are exceeding under promise and over deliver. And so I want to be extremely conservative on those numbers. This is the bottom line. Is I want to make sure that we're in there. And a 16% return. Who likes 16%?
Sign up all day long.
Okay, so I mean, 16% on extremely conservative numbers should be good enough. I don't need to, if I came out there and said, okay, we do this and I get more aggressive, and I came out and said, oh, it's a potential 22% return, okay, just out of curiosity, who would think I'm full of crap if I said 22% return? Okay. Okay, you believe me? Okay, well, I wouldn't believe me at 22%. Okay, that's not conservative enough. Okay. So again, for those who are in residential, we value the income property is only worth the income it produces. So if you produce more income, the value's higher because you're not buying something to live in or anything like that. You're buying an investment. You don't really care what the property is. You do in a way, but what you really want is what is the returns you're going to get, which we'll get that in a second. Okay, so we're all in at 36.6. So we're all in at $117,000 a door. Replacement cost for this is still $160,000 a unit. Okay. 5-year valuation, we use a 6.5% exit cap rate for a value of $45 million. Now, 5 years from now, that price is $145,000 per unit. I think that's pretty conservative on what values could be doing in 5 years. Nobody has a crystal ball for 5 years, but go back 5 years and it's a whole lot more dramatic. Okay, $144,000, there are properties selling for that right now. B-class properties are selling for that in DFW right now. So, conservative on the future valuation. So, in this, because of that, we're creating $8.5 million in wealth. Does anybody want a piece of $8.5 million? Okay. Budgeted a 5-year hold. In the PPM, we budgeted a 5-year hold without a refinance. Okay. What I anticipate happening, again, the PPM is our pro forma, what we think we're going to happen, what our business plan is. However, we've always got, just like Brian said to me earlier, there's always plans B, C, D, and E. Well, these are some of the plans. We could refinance, not refinance, get a supplemental loan. I'm going to use the term refinance just because we get money back out. We can pull out $5 million to the investors, so get about 37% cash back year 3 tax-free.
But what about the interest rates? Aren't they going to go up?
Yeah, well, here's the beauty of it, okay? Our first loan, the interest rates don't go up because we're getting a supplemental, meaning we're adding on to our existing loan. So we keep our 4.1% interest rate and we refinance, we do a supplemental loan that will be at a higher interest rate. But we still keep our 4.1% loan in place. So it's beautiful. We get to hold on to that for 10 years. If we want to sell during that time frame, that also protects us if there's a downturn. If we wanted to sell that property, it's an assumable loan, so people look for yield. Again, you're looking for yield. How much money are you going to make? If you've got a low interest rate loan, that can increase your yield because you have lower cost debt. Anybody follow that? Okay. Now, get to the point, well, what do I get? All that sounds all good. That all sounds fine, but I still don't understand, what do I get? So the top is what would happen year 1, 2, 3, 4, and 5 for the property, okay? Now, we broke that down on if somebody invested $100,000, what they would get, okay? So $100,000 year 1, $1,220. Horrible. But you got to remember, $650,000 went, rather than $200,000, $195,000, we're planning on making $850,000 that year, first year. But we're putting $650,000 back into the property so that we can have a higher yield overall. So you're sacrificing year 1. Makes it a little more of a value play. Okay, just a little bit more of a spike on a value play. 1.2% first year, but then 7.3, $100,000, you're getting $7,300. Year 4, $8,500. I'm sorry, year 3, $8,500. Year 4, wait a minute. Why'd the return go down in year 4? Interest only term runs out. Exactly. We're paying more for debt, so that yield is going to go down a little bit. Okay. Then in year 5, in these projections, if we were to sell at that time, at that 6.5% cap rate, then you would get the $8,800 in cash flow plus $147,000 back for a total $155,000, and overall return after your return of capital 16% per year. Okay. Now, look at that top number, the refi sales proceeds. You see that number right there, $21,934,000. What happens if it's a 5 cap? $13 million more than that $21 million. That's a huge number. $13 million more on 60% more. So there's a potential of having much higher. But again, I don't want to project that. I'm projecting in the PPM a 5-year hold, a sale at that time, 16%. However, cash flow should be higher because I have very conservative on the rents. The exit cap rate, I think I'm pretty conservative at 6.5%. So that should have a higher value in 5 years. Plus, I don't have the refinance in there that can also bump it. So all of those things are potential add-ons onto the 16.1% return per year. Make sense? Any questions on that? Really lively crowd. Okay. Again, the benefits, path of progress. It's one of the first things my dad said, buy in the path of progress. Okay, you don't want to go buy where it's declining. In this area, just south of Frisco, North Dallas, that's always going to be booming. There's a whole lot of land that can be developed just to the east of this property. There's some areas, so that will be future development. Now, if somebody's going to build apartments there, how much are they going to spend building apartments there? $160 a door. To have that make economic sense, what do rents need to be for $160,000 a door property? At least $1,800 a month. Because taxes are so much higher on a new property, and they don't build B-class apartments, they build A-class apartments with a whole lot more amenities and a whole lot higher cost. A-class apartments are having $7,000 to $8,000 a door expenses easy. Okay, and you can't afford to build B-class. By the way, I'm going to go ahead and say this again. B-class apartments are the only asset class with diminishing supply. What happens when you have diminishing supply? Price goes up. So we're investing in B-class apartments for that reason. If they build across the street and they're building new apartments, those rents are going to be at least $1,800. What happens to our rents if theirs are $1,800? They'll go up. We won't have all the amenities, but there's going to be a lot of people that can't pay that, and that's at least $1,800. Okay? Conservative underwriting, 16% average. Possible year 4, 53% refi. That's the part everybody looks at. I always tell Jeremy, when we're talking to Jeremy says, all anybody wants to know is there a refi possibility? Can I get my cash out tax-free and go do it again? So it's not in the PPM. I will say it again. It's not in the PPM, but it is part of our plan depending on what the market's doing. Okay? And it's a great assumable loan to help protect on the downside.